I think the two main arguments were that, number one, it seems like, again, tell me if I'm paraphrasing this wrong, but the idea is that wealthy people don't take personal loans, right? So people who have these high FICO scores, who have a lot of income, aren't out there taking a 12% loan, because a 12% loan is a ton of capital that you're giving back, right? Like, you have to pay a ton of interest on that. So that's the first thing. And then the second thing is that delinquencies are rising. We're on our way into a recession nominally. Um, Lots of people are prognosticating that we're on our way into a recession, I'll put it that way. And so during a recession, delinquencies rise a lot. And if you've got a bunch of unsecured personal loans on your books, then you're in trouble, because as those default rates rise, you're going to have to acknowledge those. You're going to have a bunch of charge-offs. It's going to hurt your bottom line. It's going to hurt your top line, etc. Those are the kind of the two things that I think that he was trying to get across. So kind of on the first one. So I'm with him in that I would never personally take a personal loan at 12%. That seems bonkers to me. And I'm also, like, between my wife and I, right, we are also SOFI's customers, right? We're kind of there. We fit the mold of what SOFI is looking for in a customer. And but I've also never taken a car loan. I have a 6-month emergency fund, a bunch of other stuff, but that's not how everybody lives. So I think Chris's argument has this false dichotomy where he says you are either fiscally irresponsible and you won't be taking a loan, or you are not a high FICO score person, right? Like, or you're a high FICO score person and you won't take the loan because you don't want to make a dumb financial decision that costs you 12% interest. And it's a false dichotomy is the problem. So that there is a giant gray area in the middle with a bunch of people who are living paycheck to paycheck, who are making 6 figures, but still living paycheck to paycheck because they don't control their spending very well, right? And you can obviously see this because SoFi, like you said, they aren't cooking the books, and their quality of borrower is really, really static across time. They're so like in Q1, the average FICO score on their personal loans was 746. In Q2, it was 748, and Q3, it was again 746. So these are high quality people. They publish in the earnings report, they always talk about how their the average salary of those people, and it's around $160,000 or $170,000 per year. So these are high earners. But the thing is that just because you're a high earner doesn't mean you're not living paycheck to paycheck. So these people are still going out, they're going to bars, they're going to restaurants, they're traveling, they're going all over the place, they're trying to do all these things, and then they get hit with something that they didn't think of, or so they have a medical expense, or they want to do an add-on to their house, or they're putting solar panels on their house, or they realize, oh crap, I've taken a bunch of loans out on my credit card, so my credit cards are overdrawn, and I should consolidate that into a personal loan that has a fixed rate, because every single month my credit card's going up. That's the vast majority of the people who refinance with us. Same thing with Lending Club. So that's why the current rising rate environment is actually a tailwind for personal loans. And they've said this multiple times, and Lending Club says the same thing. They say that this is great as far as personal loans goes, because you can refinance that higher variable rate into a fixed loan. And so there's this third, I guess, cohort of people who are looking to make either better financial decisions or have been hit with something that was out of the blue that they didn't expect, and now they need loan. But they have high. So one of the interesting things that Chris Lapointe said this week is he said that they try to originate. They look at a person's free cash flow. It's not necessarily their FICO score that they're looking at when they originate a personal loan. They try to originate to free cash flow. And so you can think of this in the context of like technology stocks right now, right? You're right. And he brought this up last week. So Google doesn't need to be laying off 13,000 people. Meta doesn't need to be laying off 13,000 people. They are gap profitable right now. The reason they're doing that is because they're cutting down, right? So if I'm a person who's living paycheck to paycheck, but I'm making $160,000 a month, and now I want to install solar panels on my roof, I can take, a $30,000 personal loan, and now I just go out and I don't drink as much, or I don't, go out to dinner, or I skip one trip to, wherever I was going to go that weekend. So you have all this excess free cash flow that you could fill with a personal loan, but and that's what they do. So they take something up front to do a renovation or to get their money right by, refinancing all their credit card debt. And the numbers don't lie, right? Like that's I guess that's the bottom line, is that we know the FICO scores. We know the salaries of these people, right? They're not cooking the books. These things are publicly available. And so those are the type of people who are taking these loans. Now, I wouldn't be one of those people, but there are $6.8 billion of originations who exist from that cohort of people, right? They exist. They're out there. It's not one or the other. There's this entire middle ground. Anyway, anybody else's thoughts can say their thoughts as well.
Yeah, I was just going to say also, there's a definition for as you start to increase with wealth, you increase your expenses, right? Lifestyle inflation, and it happens all the time. Very, very common. And I think it's hard, especially whenever doing financial planning and these sorts of things, that anyone would do anything other than the most optimal thing. But it's so true that people get themselves in sticky situations, and even though you have high FICO scores and high income, that you still need debt consolidation.
Stephen, your thoughts on what Chris said and why there are these cohorts of people that still would take these loans regardless of their income?
Yeah, I mean, look, I'd rather Chris come on because he should have an opportunity to discuss this with us.
He said he's little spooning with his wife, so.
Okay. So
that's what he said. I'm reading the chat.
He
said he's little spooning.
Steven's the most like rigid guy. He's like, I don't want to hear any of this nonsense.
So in regards to what Chris said last week, he is right from the perspective of that's his opinion. And he brings up some very good points. I don't think anybody can say he did not bring up valid points and things that should be considered. Where I would disagree with him would be Chris is very proficient with his capital. And he is probably financially more in tune than many other people.
He's not that proficient because he invested in my startup. So,
well, if you get Gary Vee on board, that may be the best investment he's ever made. But anyway, which I think you have a very good chance at, by the way.
Thank you. I appreciate it. Hopefully. All right, continue.
Anyway, the statement that he said that I'm really having a hard time with was about pulling the money out of a home and taking a home equity line, because not everybody has that option, because not everybody owns a home. In addition, not everybody owns a personal residence that's a single family house. Some people own a condominium, some people own a co-op. It is much harder to pull equity out of those two types of properties than an individual home. So there are reasons why people would be unable to pull equity out, or if they had a second mortgage on their personal home and just are not in a position to pull equity out. You never know why somebody needs to take a loan other than they need capital. And it comes down to what options are available to them. And at the end of the day, some people may not want to open up another credit card for whatever reason to transfer balance onto it. Who knows? But at the end of the day, personal loans exist. Every bank originates them. There's a reason they're out there. And if somebody is going to use it at 12% to pay off something with a higher interest rate, you're saving the spread. So he brings up valid points, but I would like to think that SOFI has some halfway decent actuaries that are building their models. And personally, I'm not too concerned about it, but that doesn't mean there isn't a right to be concerned.
I feel like this comment kind of misses Chris's point. Chris on the screen right now. So he says, so basically SOFI has a bunch of paycheck to paycheck borrows. Chris, isn't your point that you could be making $160,000 a year, but if you're installing solar panels, that's why you take a loan, which is why like you're not living paycheck to paycheck, but you would still take the loan?
So I think these people are living like if you had $30,000, it would make sense to pay for it and install the solar panels with your $30,000 that you have in the bank, rather than initiating a 12% personal loan. So I think these people are living close to. I think these people are living for the most part I think a lot of the people who probably take personal loans don't have like a big emergency savings fund or other things like that. That would be my impression, but I don't know.
Amit, could you share? I have it up. Amit, share my screen. There you go. Tell me what to do, Steven. Here.
I mean, I just think that and I don't know if this information is credible. I just found it. It seems pretty good. But if you look at this, 125 million Americans live paycheck to paycheck. 63% of Americans live paycheck to paycheck as of September 2022. Let's go down to where you are. So leave it right there. Of those who earn over $100,000 a year, 40% live paycheck to paycheck. Of those who earn between $50,000 and $100,000 per year, 53% live paycheck to paycheck. If you go down to where there's the purple highlight, there's purple highlight on mine, not yours. Go right under the pie graph. Go up a little bit, please. Right there, right there. So 21% of U.S. adults struggle to pay their bills. Of those who earn over $100,000 annually, 12% struggle to pay their bills. I mean, these numbers don't paint the greatest financial picture. And these are numbers that many people in the U.S. would classify as a high earner when you start talking about six figures. So there is definitely reasons why people would take personal loans. And you can speculate all you want about what those reasons are, if it's a good reason or a bad reason, but at the end of the day, every bank has personal loans. They originate personal loans, and this is a business in America.
Yeah, I think it's interesting because when I think of paycheck to paycheck, the mind I get in my head is someone who's, for lack of a better word, like lower income, right? But you could be making $250,000 a year living in Mountain View, California, working at Google, still being paycheck to paycheck because your lifestyle is just a little bit more enhanced, right? And I think that's where you can kind of have the financial flexibility to take a 12% loan because you have this really big salary, even if you are living paycheck to paycheck.
What I'd like to know is how many adults own their residence versus rent. That's what I'd like to know. Because right there, you take out a percentage of Americans that don't have the ability to tap the equity that they've built in their home.
Right.
I also want to talk about how, lending to people where there is a chance at default or a percent that they are expecting to default isn't necessarily a bad business model either, right? That's part of the lending game, is that there will be defaults, right? You look at a company that I used to cover called Go Easy, right? Look at their financial statements. They cover the highest of the high whenever it comes to risky people in lending. Now, they charge an interest rate to go along with that. I mean, 40% interest rates on their clients. Now, everyone thought they were going to go out of business whenever COVID hit, and then now, and I think Chris is asking me for the link. Just type in Go Easy. GSY is their ticker.
No, he asked. I sent it to him on Twitter. He wants to come on the pod.
Yeah. So they have.
But Tanner, why is that a good business if they default? Why is that a good business?
Hey, Chris,
I'm
check
not saying
the private
it's
man.
good that they default. I'm saying it doesn't, if their interest rates are set to a point where they can pay for the losses, then that doesn't mean that it's a bad business model. They are expecting losses.
Gotcha.
I'm
it's
not
almost
saying
like Target
losses.
expects
I'm saying
people
that it's part of the expected lending game, and the same with the idea of unsecured versus secured loans is that if we have secured loans, then the interest rates are going to be lower. And if we have unsecured loans, then the interest rates are going to be higher to pay for the people that default. And so this is all part of the game. Whether you say that we're going into impending doom is kind of like an, indefensible argument because it's just someone's opinion.
Gotcha. Chris, you were going to say something?
So I guess, do we want to move on to kind of the second part of this, which is the delinquency argument?
Yeah, let's go ahead.
All right. So let me pull up the chart and I'm just going to share.
While you're doing that, I can echo what Tanner's saying. It's kind of like Walmart or Target expecting people to steal from their stores. And they kind of have to bake that cost in, right?
Exactly.
They know they're going to sell so much. Some people are going to steal, and it just becomes a sunken cost at that point. Let me read some super chats also while we're doing this. We have Tyler Binder. Oh, is this Binder from the Reddit dude? I don't know. That's okay. Cool. Worked at a bank. High earners had next to nothing in savings. High earners spend everything like it's a lifestyle. That's true. Steven told me he spends a lot of money on coffee, so he is a high earner in my opinion. James says, BTW, thanks for this weekly SoFi wrap up. This represents a big investment for me, so I appreciate the source of insight. Awesome.
So can you guys see my screen now?
Yep. Yeah, hit the percent button if you can.
All right, we'll just go into like full. Does that work? Can you see the full thing? Okay. All right. So this is the exact same graph that Chris showed last week. So this is the delinquency on consumer loans in all commercial banks for the last 20-ish years. And the concern is if we are going into a recession, we're going to see something like the last 2 recessions where delinquency rates are going to go way higher than they are right now. And especially because we are way lower than historical mean, right, on delinquency rates. So this is the argument is now we're going to be charging all these off. The banks are going to, we've got these unsecured personal loans that are really high risk, right? And now all of a sudden you're going to see everything topple down. So first of all, this data includes all consumer loans, which includes really low FICO subprime people, and it also includes credit cards, which have higher delinquency rates than personal loans. So the more interesting data is this. This is from TransUnion. So they actually didn't put out an article, and I can link it or send the link to whoever's interested, where they said, okay, let's go back. People are really worried because more people are taking out personal loans now than any time previous. And if we are on the cusp of a recession, the exact same argument that Chris made, then these people are going to start defaulting at a much higher rate, and we're going at a large credit risk. So they went back and they said, let's back test this. Let's look at 2007 third quarter portfolios of unsecured personal loans across all banks, and we'll see how they defaulted based on credit performance. And you can see the credit performance down there at the bottom, right? So what qualifies as subprime, near prime, prime, prime plus, and super prime. And they took a look at this data, and this is really interesting because this corresponds to the exact time that you see here with the biggest peak in delinquency rate on consumer loans. Now, SOFI's average FICO score for the loans, and I guess the other argument he made last week that I do want to mention right now is he said, well, why do they do FICO score at time of origination? Because as they default, they're going to get lower FICO scores. TransUnion on this data that we're looking at here did the same thing. So this is based just on the FICO score during the third quarter of 2007 when they originated the loan. And then they looked at what happened. So if you look at this, pretty much our average FICO score is right in the middle of prime plus. We probably have a little bit of prime in there and a little bit of super prime, but the bulk of the loans that SoFi is originating are going to fit in that prime plus category, which means that over the next 3 years, if the trend now follows the worst trend ever in the history of like the great financial crisis, right? It was a crisis that affected all banks. Then you get about 1% of your unsecured personal loans defaulting in that time. That's cumulative from Q3 of 2007 to Q3 of 2010. So a lot of the bear arguments for SoFi, at least as far as I've seen, come down to the same thing. So you make a rhetorical argument and it sounds really, really interesting and compelling. And then I go back and I look at the data and I think, it's not a big deal.